afternoon, everyone. Today we'll be presenting our UPS stock pitch covering performance, finances, and investment potential. Let's begin. Today we'll cover UPS's background, its history, services, and competition. Then we'll review recent effects affecting its stock and key financial trends. Finally, we'll assess risks and offer our buy or sell recommendation.
UPS was founded in 1907 by teenagers Claude Ryan and Jim Casey in Seattle, Washington. Their company expanded to the East Coast by 1930 and then became the first company to provide service to every address in the continental US by 1975. They continued to expand, launching their airline in 1988 and relocating their headquarters to Atlanta in 1991. In 1999, they had their initial public offering, raising over $5 billion, which they then were able to invest back into their company. In 2018, they expanded their service to Saturdays. And in 2020, Carol Tomé became the first female CEO of UPS, a position she still holds to this day. In 2023, the unionized workers, a part of UPS, reached a historic deal that has lasting implications. And just about a month ago, here in 2025, UPS reduced their commitment with Amazon by 50%. We also want to look at the services and competition of UPS. UPS has three main segments: domestic shipping, international shipping, and supply chain solutions. Domestic shipping, of course, has to deal with moving packages around the United States. International shipping looks at the moving it to and from different countries. Um, and then supply chain solutions is kind of when businesses can partner with UPS to improve their supply chain and improve their methods of delivery. This is kind of a part of the service they offer, small business services. That logistical help falls into that category. Um, and then with large volume shipments, this is, I believe it was over 1,400 packages per day for companies that are shipping that many packages. UPS offers a program, it's a tracking and management tool that helps them really manage their shipments. Their main competitors are FedEx, DHL, and Amazon. FedEx operates a larger number of aircraft than UPS, but offers many of the same services. DHL is similar, but they have much stronger presence overseas and international freight and supply chain in Europe and Asia. And then Amazon is slightly different because they connect consumers to retailers directly, but then Amazon does also handle a lot of their own shipping in addition to outsourcing it to companies like UPS. Lastly, it's important to look at some 2024 figures for UPS. In 2024, they did $91 billion of revenue, with the majority of that coming from domestic shipping, then a larger portion coming from international shipping, and lastly, supply chain solutions. However, the profit breakdown is slightly different, where while domestic shipping still provides the largest profit, the ratio between domestic shipping and international shipping is much closer, which shows that international shipping might be more profitable when just looking at the raw numbers. And then supply chain solutions. This is definitely their smallest segment, but still does well.
So we conducted a SWOT analysis for UPS. Some strengths, as you can see, include their strong brand and reputation, their extensive global network, and they have one of the world's largest cargo airlines. Some weaknesses include their high operating costs, their environmental restrictions, and their dependence on third-party suppliers for things like warehouses and plane rentals. But looking forward, some opportunities they have is expanding into new markets, the growth of the supply chain management sector with the potential of U.S. tariffs, and technological advancements with things like the adoption of electric vehicles. Some threats that they may face in the future include the expansion of Amazon's own delivery service, the potential international trade conflict we've mentioned, and the rising fuel and labor costs. Here we're just going to look at some relevant company events that have happened. So on January 29th, UPS announced that they will be cutting Amazon's volume by 50% in a strategic bid to focus on business with higher margins, which resulted in a drop in the stock price. On January 30th, however, they did report that their quarter four earnings were higher in both revenue and profit compared to the quarter four of the previous year. And on February 5th, they announced that its regular quarterly dividend of $1.6 per share would be paid on March 6th. So here we see that Amazon represented nearly 12% of the UPS revenue in 2024. So they were definitely very reliant on them. So moving away from Amazon will allow UPS to conduct business with higher margins. specifically in healthcare, business to business, and small or medium business segments. But we do expect lower revenue in 2025. However, the profitability should rise in the long term. So here we compared UPS with their two largest competitors, FedEx and DHL, with different metrics like stock price, market cap, profit margin, debt to equity ratio, beta over the last 5 years, and their free cash flow. As we can see, UPS leads in both market cap and profit margin, which is good. They also do lead in debt to equity ratio, which is definitely not ideal. And as we can see, they have a lower beta than both FedEx and DHL, meaning they're a little bit less volatile compared to the movement of the market. So they do have the better profit margin now, but as they reduce their business with Amazon, this may tank lower for the next couple of years. Again, the debt to equity ratio will hopefully decrease if they follow their plans to increase their profitability with their reduction in business with Amazon. And the market cap is definitely a good sign. They're establishing a dominant position in the industry, and hopefully in the next 5 years they can continue this trend.
Now that we've seen how UPS compares to its competitors, let's examine its stock performance over time. This graph shows UPS's stock in blue versus the S&P 500 stock in red from January 2018 to the end of 2019. Notice that while the S&P 500 enjoyed relatively steady growth, UPS experienced higher volatility and slower gains. One key factor in this was the U.S. tariffs on China in 2018 under the Trump administration, which disrupted the supply chains and created uncertainty for UPS as a whole. Although these tariffs stayed mostly in place until early 2020, the Trump campaign has hinted at their return. Given UPS's sensitivity to such policies, similar future tariffs could once again affect its stock performance. To wrap up, new tariffs could cut UPS's shipments, raise costs, and trigger volatility in the stock. We see a short-term short opportunity, but it's not a long-term play. Monitor policy shifts when taking this action because UPS may recover quicker than it did in 2018 with its improved supply chain management system.